Did you enjoy Monday and Tuesday more than last week, Stephanie, or it's just we're really not enjoying any of this because we don't know what's yet to come?
Well, I'm not enjoying it that much. So good morning. It's good to see you, Joe. I think we're in this trading range. We're going to stay volatile. I think the reason we had the rally over the last 2 days was because we were very oversold. We had the worst September since 2002. You guys know that. We also had people starting to think about the Fed pivot again. And this is what happened in June, sparking that rally. And this was post the UK pivoting, both fiscally and on a monetary policy basis, and also Australia raising rates, but at a lesser rate than expected. But I also think the inflation number in the ISM manufacturing report was very encouraging on the price component, the lowest since June of 2020. So inflation in that series has come down quite a bit. So people looked at all these things and said, Fed pivot. Problem is, the Fed is telling you that they're not going to pivot, number one, unless they break something. And number two, there are numbers that they look at that are still way too high. So they look at the core PCE. That's the most important inflation metric they look at. And it's at 4.9%. Wages and salaries, we saw up 8.6%. This is year-over-year numbers. And rents remain high. And then in the last couple of days, we've seen commodity prices also stabilize. So I don't think they're going to pivot. And I worry that all of these rate increases and the speed at which they've increased the rates are really, we're not going to know about it and how it impacts the economy for another 6 months or so. And we've seen it in housing, but in other things, it'll show up down the road. And so that's why I think it's going to be a volatile situation and probably a recession in 2023. Market's reflecting a lot of bad news, though, so I am looking for opportunity.
It could happen quickly. The stubborn parts that are still holding up could happen quickly. And do you think that what the Fed's done already could have prevented or presented issues now without any further increases? Some kind of break something or things slow down too quickly, labor market erodes too quickly with what they've done so far? They've already moved quite a bit.
Housing worries me a little bit, and we'll hear from the banks next Friday about mortgages, housing delinquencies, non-performing loans, that kind of thing. But you mentioned jobs. They are still high. I know the jobs number came down. I know a lot of people were talking about that yesterday, but you're still just shy of 11 million job openings out there. So I think that component is the thing that we are looking for to really change. And I don't know if it can change that quickly. Housing can turn really big time, and we've seen it, but not so much on jobs, and certainly not so much on wages, right? And rents. Rents follow home prices. Home prices are actually still up in some places, double digits.